So what does all this mean? Well, we have short memories. A market crisis can hurt. It doesn't matter what sector you're in or what business model you have. A global crisis can dramatically affect everything you're doing in your business, and with immediate effect. Another global crisis is building right now. 8 years of quantitative easing and central bank money printing has created a monster. In this time, it could be worse, deeper, and longer. The central banks and governments around the world just don't have as much ammunition to save the day as they did back in 2008 and 2009. Now, just as a brief disclaimer, the study is not intended for academic research or for nitpicking over small details. It's intended to give perspective about the risks in the financial markets that we face as company leaders and which we may not be so aware of. Looking at current market conditions now, the debt to GDP ratio has increased in all advanced economies since 2007, and some in a very dangerous way. Since 2008 in Europe, government debt to GDP has skyrocketed. A higher debt to GDP ratio is acceptable when an economy is rapidly growing, because its future earnings will be able to pay off the debt more quickly. But it's not acceptable in an economy that is not rapidly growing. And that unfortunately is the case in most of the world today. In Spain, debt to GDP is high and growing, and yet its GDP growth rate is low. Italy's debt to GDP is very high and growing, and its GDP growth rate is very low. Portugal's debt to GDP is very high and flat, and yet its GDP growth rate is very low. The UK's debt to GDP is high and growing, and its GDP growth rate is low. France's debt to GDP is high and growing, and its GDP growth rate is low. Belgium's debt to GDP is high and growing, and its GDP growth rate is low and flat. A bright spot, Germany's debt to GDP is medium and declining, and its GDP growth rate is medium. Switzerland is relatively unconcerned, as it has a low and stable debt to GDP ratio, but it has a low and declining GDP growth rate. What about China? China has a low but rapidly increasing debt to GDP ratio, and its GDP growth rate is high but declining. One concern about China is that it's in a real estate bubble, with residential prices up 80% in Shenzhen and 65% in Shanghai in Q1 of this year, and the yuan per square meter has doubled in the past year. What about the U.S.? In the U.S., debt to GDP is high and increasing. In the U.S., there is $19 trillion in government debt, or $162,000 per taxpayer. The U.S. GDP growth rate is low and flat. The U.S. economy is growing at a very slow pace. In fact, the 2.1% growth per year since 2009 makes the current economic recovery in the U.S. the slowest recovery since World War II. And the U.S. 10-year Treasury bond yield is at an all-time low. Elliot's Paul Singer says this bond bubble is the biggest bond bubble in world history. And perhaps the most concerning fact of all is that the U.S. is moving to the 0 point, i.e., the point at which a dollar of debt no longer produces any GDP. Every dollar of debt has produced less and less GDP since 1996. The more money that is printed, the less effect it has. What about Japan, which is the world's third largest economy? Debt to GDP is very high and growing. Its GDP growth rate is very low and declining, and Japanese investors are leaving Japan. So, high debt, low GDP growth rate. Not good. What about unemployment levels? In Europe, unemployment levels are still high, too high, especially youth unemployment. So high debt, low GDP growth, and high unemployment mean negative interest rates. The poor economic conditions have caused several of Europe's central banks to cut interest rates below zero to encourage lending. Italy is issuing government notes at a negative yield. The average yield on the German 5-year note is now minus 0.5%. The average yield on the French 5-year note is now minus 0.4%. The yield on the Spanish 10-year bond has fallen below 1%. And in the UK? The UK 10-year note is now only 0.6%, having declined significantly since the Brexit vote. There have been steep fund outflows from the UK since Brexit. The current account deficit in the UK is now more of a problem, since deficits are financed by foreign investors, and leaving the EU will make it more difficult for the UK to attract such investors. This means funding the deficit with a weaker pound or higher interest rates. A weaker pound is expected to drive up inflation rates, as well as inflate risky assets. For Q3 of this year, the UK is expected to be the only major economy in reverse. Yet, look to the Bank of England potentially cutting rates even further.